In the monetary policy review by the RBI, all the key rates have been left unchanged. This is on expected lines, and the RBI continues to lay accent on the need to sustain growth in preference to price stability. Something which the market participants have been eagerly looking forward to is the language and tone of the policy statement. When no substantial changes are taking place, the tone of the policy statement would convey more about the things to come. Inflation is projected at 5.70% for the current year, and that's very close to the 6% upper band. This is on the higher side, but RBI believes that the available data points to exogenous and largely temporary supply shocks driving the inflation process. The domestic economy has started normalizing due to the gradual opening up of the economy. The GDP growth projection is retained at 9.5% for 21-22. RBI has also announced a series of variable rate reverse repos, which would mean a temporary withdrawal of a certain amount of liquidity. An important objective of such an operation is to carry out adjustments in the short-term rates. Quite often, due to easy liquidity conditions, the short-term rates may trade at levels lower than the reverse repo rate. The yields on even short-term treasury bills have been somewhere close to the reverse repo rate. The variable rate reverse repos would help in pushing up the short-term rates a bit to correct this situation, and the short-term rates may edge higher due to this. The monetary policy is clearly in transition towards normalization, and with normalization in growth, normalization of liquidity too may happen. While there may not be any policy rate changes in this calendar year, the actions towards normalization of liquidity are likely to accelerate in the second half of this financial year. The statement from the RBI is very significant. The MPC continues to be conscious of its mandate of anchoring inflation expectations as soon as the prospects for strong and sustainable growth are assured. A change in the tone is felt.